Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So far 10 problems, 10 main problems and 14 short problems I've completed on this topic of ratio analysis. Remember, ratio analysis is a very important analyzing technique. Financial statement analyzing techniques are many. Comparative statement, common size statement, trend analysis, so many techniques are there, but the most widely used technique is ratio analysis. Throughout the world, everywhere, the most important analyzing technique used by financial analysts is the ratio analysis. That's why this topic is there from graduation level to post-graduation level, even for professional levels. This topic is very, very important. So normally what I have seen in my career, many students will skip this topic because they think that they have to remember so many formulas, but it is wrong. In real practice, this technique will be widely used in every business to analyze, to get the information from the financial accounts, from financial statements, to take the decisions. So very important information we can get from ratio analysis. So don't ignore. Watch the first 4 theory videos. Be perfect about the concept, meaning, advantages, uses, then formulas, then significance of each and every ratio. Then you can enjoy learning this topic of ratio analysis. Don't make it a phobia that this chapter is very difficult. Now, I am putting my 100% effort to explain you each and everything regarding ratio analysis. So watch the video till the end. Don't skip in between. Don't join in between. So before starting the 11th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep it ready. Take the screenshot of this 11th solution, then I'll explain. Now, see the 11th problem. Following is the balance sheet of Sagar Limited for the year ending 31st March 2017. Calculate ratios for testing liquidity and for testing solvency. Previous problems, specific ratios were given where we have applied the formula and calculated the ratio. But from this problem onwards, we have decision making problems. It will not specify which ratios you have to calculate. It is left to the students to decide. The only thing given in the problem is we want to test the liquidity and we want to test the solvency. So a student must know what are the ratios used for testing the liquidity. What are the ratios which can be used for testing the solvency. Though directly it is given only testing liquidity and testing solvency. So what information is given? Balance sheet is given, shareholders fund, share capital, note number 1, reserves and surplus, note number 2. Then 12% debentures, current liabilities are payables, provision for tax, bank overdraft, 3 current liabilities, total of the liabilities. Then assets, we have tangible assets, intangible assets. Current assets are short-term investments, inventories, receivables, cash and cash equivalent. This is the complete balance sheet given. Notes to accounts. Note number 1, share capital. Under share capital, we have equity share capital 5 lakh, 9% preference share capital 2,50,000, total 7,50,000. That's what given in the balance sheet. Similarly, reserves and surplus. General reserve consists of 50,000, profit and loss account balance 2 lakh, total 2,50,000, that is given in the balance sheet. That's all. This is the only information given. We are not given the statement of profit or loss because we are not concerned with profitability. We are concerned only with testing the liquidity and testing the solvency, right? Now, first we apply the ratios for testing the liquidity. Testing the liquidity. Already I have explained in the theory videos. There are different, 3 ratios are there. 3 ratios are there which are very important for testing the liquidity position of the business. What do you mean by liquidity? The ability of the business to pay the current liabilities on time. Every business will have current obligations. monthly salaries have to be paid, wages have to be paid, electricity bill, rent, telephone bill. These are the regular payments. So for making these payments, sufficient current assets should be maintained. So whether the business has having ability to pay the current liabilities on time, that is called liquidity. The first ratio to test the liquidity is current ratio. Current assets by current liability. If you see the problem in the balance sheet, current assets, 4 current assets are given. That is short-term investments. Then inventories, receivable, cash and cash equivalent. Take the total here. This is short-term investment, inventory, trade receivable, cash and cash equivalent. Total 5 lakh. Current liabilities are given 3 items. Payables, provision for tax, bank overdraft. These are the 3 given in the problem. So all the 3 I have taken the total. It comes to 2 lakh. So current assets are 5 lakh, current liabilities are 2 lakh. So 5 lakh divided by 2 lakh, 2.5 is to 1. The standard current ratio is 2 is to 1. But here we have 2.5 is to 1. So we can conclude the current ratio shows the business is having good liquidity position. The business can be able to pay the current liabilities on time because the current assets are 2.5 times more than current liabilities. Right. Now I'll come to the next ratio, quick ratio. The formula for quick ratio is quick assets by current liabilities. The quick assets we can get by subtracting the inventory from current asset. From current asset, deduct the inventory, we'll get the quick asset. Minus prepaid expense is also there, but in our problem we don't have any prepaid expenses. What is the total of current assets here? 5 lakh. 5 lakh is the current asset minus inventories. If you see the balance sheet, inventory 3 lakh, deduct 3 lakh. There are no prepaid expenses. So 2 lakh rupees is the quick assets and current liability is also 2 lakh. Current liability also 2 lakh. So 2 lakh by 2 lakh, 1 is to 1. The quick ratio is 1 is to 1 and the standard quick ratio is also 1 is to 1. So normally it is said that if quick assets are equal to current liability, then the liquidity position is good. Here it is good. Then absolute liquid ratio, another ratio for testing the liquidity is absolute liquid ratio. The formula is absolute liquid assets by current liabilities. What do you mean by absolute liquid assets? The assets which can easily be converted into cash. Example are short-term investments or marketable investments. And second, cash in hand, cash at bank. So simply we can say short-term investments and cash equivalent combined. That will give you absolute liquid assets. The short-term investments plus cash and cash equivalent. In our problem, 10,000 is short-term investment and 1 lakh rupees are the cash and cash equivalent. Add up 1 lakh 10,000. Absolute liquid assets. The formula absolute liquid ratio 1 lakh 10,000 divided by current liability 2 lakh. It comes to 0.55 is to 1. So according to financial analysts, they says the absolute liquid ratio standard should be 0.5 is to 1. 0.5 is to 1. But here we are having 0.55 is to 1. That means above standard. So from these 3 liquidity ratios, we can conclude that the liquidity position of the company is good because all the 3 ratios are above standard. The current ratio 2.5 is to 1, the quick ratio 1 is to 1 and the absolute liquid ratio 0.55 is to 1. Good liquidity position. So after calculating this ratio, you have to give the comment. You have to give the interpretation. So while watching this video, always keep a notebook beside you and a pen. When I say something, immediately you should write it down, note it down. Then you can be able to remember, right? So we have completed the liquidity ratio. Now I am coming to solvency ratio. Solvency means whether the business can be able to go for a long period of time or not. Whether the business is having sufficient long-term funds or not. If the business is financially sound, then it can go for a long period of time. When the business is can go for a long period of time, if it is having good combination of owner's fund and borrowed fund. Normally a business will not depend on only capital. Apart from capital, a business will borrow long-term loan or debentures like that. There should be a proper combination of owner's fund and borrowed fund, and that will be disclosed by solvency ratio. The first solvency ratio is debt equity ratio. Debt equity ratio. The formula for debt equity ratio is long-term debt divided by shareholders fund. Long-term debt means non-current liability. In our example, in our problem, the non-current liability is debentures. So debentures are long-term debt. How much are the debentures given? 2,50,000 given in the balance sheet. Now shareholders fund. Shareholders fund consists of equity share capital plus preference share capital plus general reserve plus profit and loss account balance. All these things I have already explained in the starting first, second videos. Starting theory videos I have explained. So equity share capital plus preference share capital plus general reserve plus P&L account balance. All these things are given in the notes. So add up all, you'll get 10 lakh rupees. Equity share capital, preference share capital, P&L account reserves. Then debt equity ratio, long-term debt is 2,50,000. Shareholders fund is 10 lakh. So 2,50,000 by 10 lakh, 0.25. First solvency ratio completed. The second solvency ratio is proprietary ratio. The formula for proprietary ratio, net worth by total assets. And net worth means shareholders fund. Net worth means shareholders fund. Already shareholders fund we have calculated 10 lakh. So shareholders fund 10 lakh. And total assets are given in the problem. Balance sheet total you can see 14,50,000. So 10 lakh divided by 14,50,000, 0.69. This is the proprietary ratio. The next ratio is capital gearing ratio. The formula for capital gearing ratio is funds bearing fixed interest and fixed dividend divided by equity shareholders fund. The funds bearing fixed interest and fixed dividend, those are debentures and preference share capital. On debentures there is fixed rate of interest. On preference share capital there is fixed rate of dividend. So numerator will take debentures and preference share capital. And denominator will take equity shareholders fund. Equity shareholders fund consists of equity share capital plus general reserve plus P&L account balance. Preference we should not take. So here equity shareholders fund, equity share capital plus general reserve plus P&L account. Add up the three, we'll get 7,50,000. So capital gearing ratio, 2,50,000 are the debentures and 2,50,000 are the preference share capital. Denominator equity share capital 7,50,000. So 5 lakh divided by 7,50,000, 0.67 is the capital gearing ratio. The next ratio is fixed assets ratio. The formula for fixed asset ratio, fixed assets by capital employed. Now fixed assets consist of both tangible fixed assets and intangible fixed assets. Add up, we get 9,50,000 given in the problem. Now capital employed. Remember, capital employed means shareholders fund plus long-term debt. The long-term debt are debentures. So simply you add debentures to shareholders fund. The shareholders fund are 10 lakh, already you have calculated here. Shareholders fund 10 lakh. And debentures are 2,50,000. So 10 lakh plus 2,50,000, 12,50,000, that is the capital employed. Now fixed assets ratio, 9,50,000 fixed assets, 12,50,000 capital employed. So 0.76 is the fixed assets ratio. Now we can make the conclusion regarding the solvency ratio. The solvency ratio, debt equity ratio 0.25. It means the debt is 25% of shareholders fund. It is good because normally debt will act as a leverage in lifting the profitability. If we keep a small amount of debt, the profitability will increase. The profitability will increase. That's why it is suggested, it is advised to have some amount of debt. Next, proprietary ratio. It shows the proportion of the total assets which are financed by shareholders fund. In our problem 0.69, or we can say 70% of the assets are financed by shareholders fund. Remaining 30% of assets are financed by outsiders. It shows a good trend because normally the owner's money should be more than outsider. Here owner's money is 69%. Out of the total assets, 69% of assets are financed by shareholders. Then capital gearing ratio. The funds bearing fixed interest, fixed dividend percentage are 67%. 67% are those funds which bear fixed interest and fixed dividend. Last, fixed assets ratio. The fixed asset ratio shows 76%. That means 76% of the capital employed is invested in fixed assets. Remaining 24% is invested in current assets. So from this analysis we can conclude the liquidity and solvency position of the business is satisfactory. This is the end of problem number 11. So just now we have completed problem number 11. Now I am continuing the problem 12, 13, 14. These three problems I am going to continue now. So watch the video till the end to get the complete command. Before starting, take the screenshot of the solutions of 12th, 13th and 14th problem. Then I'll explain in detail. Now, see the 12th problem. The following balance sheet relates to Nagarjuna Company Limited. Balance sheet of Nagarjuna Limited as of 31st March 2017. So, equity and liability, shareholders fund, share capital and reserves. Non-current liabilities are debentures 1,50,000. Current liabilities are payables, trade payables and bank overdraft. So, total of the liability side 7,30,000. Now, next page, assets. The fixed assets are tangible, intangible. Then current asset, inventory, receivables, cash and cash equivalent. Total 7,30,000. The company's sales during the year amounted to 4,50,000. You are required to assess the liquidity position of the company. So only balance sheet is given and last one sentence sales are given. But sales we don't require for calculating liquidity. So just you ignore the sales given. We have to focus only on liquidity ratio. Just now I told you, specifically it will not give that this ratios you have to calculate. You have to decide yourself. Only the thing is given, assess the liquidity position of the company. And we know the liquidity ratios are current ratio, quick ratio and absolute liquid ratio. So these three ratios we calculate for this company Nagarjuna Limited and give the comment about the liquidity position. That's it. See here, Nagarjuna Company Limited testing the liquidity position of the business. Current ratio, current assets by current liability. So here three current assets are given: inventory, trade receivable, cash. Add up 2,30,000. Current liabilities are given two. What are the two current liabilities are given? That is trade payable and bank overdraft. So trade payable and bank overdraft, two current liabilities are given. That is added 80,000. Now current ratio CA by CL 2,30,000 by 80,000, 2.875 is to 1. First current ratio we have calculated. Now quick ratio. Quick assets by current liability. It is also called acid test ratio. Both mean same. So quick asset is equal to current asset minus inventory. Reduce and ignore the inventory and find out the current assets. The total current assets are 2,30,000. So 2,30,000 minus 25,000, 2,05,000 is the quick asset. Current liability already we have calculated 80,000. So 2,05,000 by 80,000, 2.56 is to 1. That is the quick ratio. Now third, absolute liquid ratio. Absolute liquid assets divided by current liability. What are the absolute liquid assets? That is short-term investment or marketable securities plus cash and cash equivalent. So two things you have to add for absolute liquid assets. What are those? First, short-term investments or marketable securities plus cash and cash equivalent. In our problem, there are no marketable securities, only cash is there. So that cash will take 80,000, right? So current liability 80,000. Absolute liquid ratio is 80,000 by 80,000, 1:1. That's all. It is asking you to assess the liquidity. We have assessed the liquidity. Now give the conclusion. I have not written the conclusion here, but in the examination you must write the conclusion. That's why I am telling you, keep a notebook whenever you watch this video. Immediately you write the conclusion. I am dictating now. This current ratio. The standard current ratio is 2:1. But the current ratio of this company Nagarjuna Limited is 2.875:1. It is more than 2. So we can conclude that current ratio is above standard. So the liquidity position is good according to current ratio. Now quick ratio. The quick ratio, standard quick ratio is 1:1. But here we are having 2.56:1. That means it is more than the standard. That means the quick ratio also indicates that the liquidity position of Nagarjuna Limited is very satisfactory, very good. Now absolute liquid ratio. The absolute liquid ratio standard is 0.5:1. That means the absolute liquid asset should be 50% of current liability. But here it is more than 50%. 1:1. 1:1. That means it is above standard. So all the three, current ratio, quick ratio and absolute liquid ratio, indicates that the liquidity position of Nagarjuna Limited is satisfactory, is quite good. The company can be able to meet all current obligations on time. That's it. This is the conclusion of 12th problem. Now 13th problem. You are given the following information about two companies, RP Limited, RS Limited. So two companies' comparative data is given. Cash, debtors, inventory. These three are the current assets. And bills payable, creditors, accrued expenses, tax payable. These four are the current liabilities. Calculate the liquidity ratios for the two companies and interpret the liquidity position of the companies. It is asking you again to calculate the liquidity ratios. Three liquidity ratios. Current ratio, quick ratio, absolute liquid ratio for both the companies. And we have to interpret, give the conclusion regarding the liquidity of both these companies. Which company is better from liquidity point of view? That's what. So first of all, we have calculated the current assets and current liability for both the companies. Three current assets are the cash, debtors, inventory. Add up the three. We got current assets 3,40,000, 8,74,000. Four current liabilities are given: bills payable, creditors, accrued expense, tax payable. The total of the current liability are 1,67,000 and 72,500. Now quick assets. The quick assets means current assets minus inventory. Deduct inventory from current assets. Current assets are how much? 3,40,000. Minus inventory is how much? 1,80,000. So 3,40,000 minus 1,80,000, you get 1,60,000. Similarly, 8,74,000 minus 5,40,000, you get 3,34,000. These are the quick assets. Now, absolute liquid assets consist of short-term investments or marketable securities plus cash and cash equivalent. In our problem, we don't have short-term investment. We have only cash. So cash, we will take it as absolute liquid assets. So we have made the calculations. Current assets, current liability, quick assets and absolute liquid assets. Now we calculate the ratios. Substitute the values in the formula. So current ratio. The formula is CA by CL. Already we have calculated 3,40,000 divided by 1,67,000. 2.04:1. For RS Limited, 8,74,000 divided by 72,500. 12.06:1. One ratio we have completed, current ratio. Then quick ratio, quick asset by current liability. The quick assets are calculated here: 1,60,000, 3,34,000. 1,60,000, 3,34,000. Divide by current liability. Current liabilities are same, 167 and 72,500. So 0.96:1, 4.61:1. The third ratio is absolute liquid ratio. Absolute liquid assets by current liabilities. Absolute liquid assets you have calculated here 18,000, 14,000. So 18,000, 14,000. Denominator current liability, same current liability 1,67 for 72,500. 0.11:1, 0.19:1. We have made all the calculations of liquidity ratios. Now it is asking you to interpret of both the companies and give the conclusion which company is better from liquidity point of view. First, the standard current ratio is 2:1, but the current ratio here is 2.04:1 for RP Limited. For RS Limited, 12.06:1. It's very, very high. So comparatively, the liquidity of RS Limited is very good, but from profitability point of view, it is very bad. It is not suggested to keep the current ratio of 12:1. It denotes that idle funds are invested in current assets. The current assets normally should be 2. Normally should be 2 or 3. Not more than 3. If more than 3 current ratio is there, it means the company is having idle funds invested in current assets, which will not generate any profit, but which will incur cost. It will reduce the profitability. So it is suggested not to keep so much of current assets. Secondly, quick ratio. The standard quick ratio is 1:1. Here it is 0.96:1. Here it is 4.61:1. The RP Limited is having 0.96:1, which is just below the standard of 1:1. Just below the standard. Whereas in case of RS Limited, it is 4.61:1. It is very high. We have to keep only 1:1. They are keeping 4.61:1. It denotes that RS Limited is having very high liquid assets. It should not keep so much of liquid assets, idle funds. It indicates there is idle fund invested in quick assets. That means it will reduce the profitability. No doubt liquidity is very good, but profitability will come down if you keep so much of current assets and quick assets. Last one, absolute liquid ratio. The standard absolute liquid ratio is 0.5:1. But unfortunately, both the companies are having very low absolute liquid ratio. That is 0.11:1, 0.19:1. It indicates very low. So from absolute liquid point of view, both the companies are bad, not satisfactory. They have to increase the absolute liquid assets, that is cash balance, they have to increase a little bit. So from these calculations, except absolute liquid ratio, the other ratios are good for RP Limited. And RS Limited shows excessive amount of current assets and quick assets investment. The liquidity no doubt is very good, but profitability will come down. So we suggest RS Limited not to invest so much money in the current assets and quick assets. Remove that investment and make the investment in some other activity so that the return should increase. That is the conclusion about RP Limited and RS Limited. Now, the next problem is problem number 14th. In this 14th problem, we are not required to make any calculations, only conclusions or interpretation you have to give. What is the problem? The standard ratio for the industry and the ratios of the company A Limited are given. Determine the efficiency of the working of the company. Here, the company's performance is compared with the industry standard. Industry consists of a group of companies producing similar goods, like cloth industry, means all the companies producing cloth will become this cloth industry or textile industry. Similarly, cement industry, all the companies producing cement will be called industry, cement industry. So here industry standard is given, company's performance is given. We have to compare the ratios of the company with the industry and conclude whether company is performing as per the standard or below the standard. Now, current ratio, gross profit ratio, fixed expense to sales ratio, variable expense to sales ratio, sales by capital, fixed assets by long-term funds, rate of return on capital. So these are the items given. For each one, ratios are given. One by one we'll discuss. Current ratio. The current ratio of industry is 2.5, whereas the company current ratio is 1.9. The standard current ratio is 2 is to 1. 2 is to 1. Whereas the company is 1.9. It's very near to 2. Whereas the industry standard is 2.5. Still, we can say the company's liquidity position is not bad. It's very near to the standard. We need other indicators of this liquidity, position regarding the breakup of all the current assets. Not only on current ratio, also we have to study the quick ratio and also absolute liquid ratio to give the final conclusion on liquidity. Right now we can say still the company is satisfactory because it is 1.9, very near to standard of 2. So here, though the current ratio is below the industry standard, it is close to the ideal ratio of 2. It is very near to 2. Other indicators of liquidity need to be studied to understand the variation from industry standard. The difference is that 2.5 is the industry and 1.9. Why it is the difference? We have to study further. We want further information about liquidity. Then only we can finally give the conclusion about the liquidity. Second ratio is gross profit ratio. The gross profit ratio of the industry is 0.3, 30%, whereas company is 35%. The gross profit ratio is higher for the company. It indicates that the company is doing good business compared to the industry standard. So here gross profit ratio of the company is quite satisfactory in comparison to the industry standard. So comparing with industry, the company is performing good regarding gross profit. Next one, fixed expenses to sales ratio. The ratio of fixed expense to sales is 15% for the industry and 20% for the company. That means the company's fixed expense ratio is more than the industry. That means the company is not performing up to the level. If we increase the production, if the company increases the production, then definitely the fixed expense to sales ratio will come down. The ratio is high, indicating that the company is not doing full performance. The company is not utilizing the full capacity. If the company uses full capacity, this ratio will come down. So the fixed expense to sales ratio, the company figure is greater than that of the industry. This can be on account of low production. Low production, that's why this ratio is higher. With the increase in production, the fixed expense to sales ratio will come down. So we suggest the company to increase the production, then only this ratio will come down. Next, variable expense to sales ratio. Proportion of variable expense to sales. The industry standard is 0.10, 10%. Company is 0.08, 8%. So variable cost of the company is lower than the industry standard. It indicates that the management can be able to control the variable expenses, only 8%, whereas industry standard is 10%. It's a better point. Company is doing good in controlling the variable expenses. So variable expenses, the company has managed to keep its variable expenses under control. Next one is sales by capital. How many times the sales are of capital? So in industry 3 times, whereas company is 4 times. That means that sales turnover compared to capital is higher for the company. It is 4 times, whereas industry standard is only 3 times. That means company is doing good sales. Good sales on capital. 4 times of capital is the sale of the company, whereas 3 times of the capital is the sales of the industry. So higher the ratio, greater is the efficiency of management. The company is able to generate greater sales from limited capital. From limited capital, higher sales the company is doing. Very good. The next one is fixed assets to long-term funds. The fixed assets to long-term funds. Industry 1 and company is 0.9. 0.9. This indicates the funding pattern. That means how the fixed assets are purchased. So normally it should be 1 or below 1, it will be better. Because all the fixed assets should be financed from long-term funds. So the fixed asset should never be more than 1. Industry is 1, but the company is 0.9. It indicates that the company's funding pattern is good compared to the industry. because it is investing only 0.9, less than 1. So fixed assets long-term fund, it indicates the funding pattern of fixed asset. A lower fixed asset long-term fund is favorable. The funding pattern of the company is better than that of industry. Just now I told. The company's funding pattern is better because it is less than 1. Last one is rate of return on capital. That means return on capital. 15% for the industry and 20% for the company. The company's return on capital investment is higher. It indicates that the profitability of the company is good compared to the industry average. Final conclusion, the overall working of the company is better than the industry standard. By studying all these ratios, we come to the conclusion that the company's performance is much better than the industry standard. So this is the end of problem number 14. Totally 14 main problems we have done. In this problem, starting problems are on calculating specific ratios which are given. The next type of problems are interpretation problem. Ratios are given and we have to interpret, we have to give the conclusion that we have done. Next problem is reverse back problem. That means ratios are given. By using those ratios, we have to prepare the financial statements. That will take up in the next video.